Okay, so now I want to talk about the process of analyzing financial performance and the reporting process that goes within that. And both of these go hand in glove. So I'm going to talk about these two things together in this topic. Um, Reporting. So I just finished talking about the systems and how they produce these reports, and then those reports go to management, be that for us or our bosses, and we're asked for explanations and identification of variance and what we're going to do next and so forth. So the purpose of the reports that these systems produce, that we ask these systems to produce, is so that we can share information across the organization. As I talked about with at the start of this tutorial, the planning process uh, spans across the organization. What we do at operations in terms of our budgets and our performance, financial performance, has ramifications across all levels of the organization, feeds into other budgets and so forth. So reports are important for sharing that information, particularly around budgets in terms of telling us what we can spend and what's expected of us, but also in performance reports as we're going through those budgeting periods, telling us how we're performing and so forth. So it's also important outside the organization, particularly when it gets to investors. So financial reports for publicly listed companies is mandated because it needs to let investors know and shareholders know what's going on in terms of the numbers and the finances in businesses. So things like, to assure creditors that we have sufficient equity, that we can cover off our debts and so forth. Uh, Reports are also really important for auditing purposes, and I'll finish up this tutorial a bit later with talking about auditing. But when people go around and checking that we're doing everything as we should, reports are really important to use as a evidence-based tool for that. And reports are also really important in terms of taxation, and I talked about our legislation requirements around taxation earlier, and why that's important. And of course, whenever we're dealing with information, especially around reporting, we need to make sure that it's good quality information, and that is, it's comes from a valid source. It's consistent with other sources. It's accurate in the sense that it's correct and it's honest. It's fully transparent. There's nothing being hidden. It's not being inaccurate by omission, and it's up to date. That all the figures on there are current and up to date. And of course, and I should say that with these reports, in most large organizations, you've got separate sections of the business, be they like business managers or accountants or accounting departments that are responsible for the number crunching. That is the overall financial management, making sure the systems are in place and that the systems are working well and that the reports are coming out on time. Uh, those accountants or accounting type roles are responsible for crunching the numbers. When it comes to us, we're really more responsible in terms of accounting for those numbers. So, uh, so even though we've got systems and individuals who will collate those numbers and report on those numbers, then it comes to us. We have to analyze, we have to investigate, we have to identify any issues, and we have to report up on what we're going to do. And that's around recommendations and dealing with variance. So we should always be, when we're thinking about analyzing and identifying issues and so forth, we should always be balancing the quantitative data, that's the numbers, with the qualitative information that are the experiences. So for example, we can't just look at the numbers if there are other factors in the background besides the numbers that are influencing those numbers, cause and effects, for example, the whys, how perceptions about people feel about things, or your personal opinions on how this is going, why this is happening. We're always looking for a balance of those two. So you might say, our sales or our costs were up or down this much, and that's this significant break. The reasons for this based on is, and you might have some quantitative data on this, flow through the pipeline was 20% down. However, our sales department feel that they're just about ready to stitch up 3 big clients, and that's going to bring this much revenue in the next month. So you can supplement the numbers with some of those qualitative information, and I call them those experiences. And this helps when you're sending these reports up the line, in particular, within our scope of responsibility, this helps us to be able to give the reader more of an holistic and complete understanding of what's going on. And of course, I should say that should always be evidence-based. It should be grounded in evidence first. All right, so I want to talk a little bit about this, not only the importance of reporting, but also about analysis. And some of you who are listening to this may well have quite a bit of experience around financial analysis, but for those of you who haven't, I just want to take a little bit of time to step through what a typical report might look like in terms of a performance report. This one's a profit and loss statement for the month of February, and this is fictitious, by the way. I just put some numbers together that give me something to talk through. What would we do? How do we go about analyzing it and thinking about it? Well, there's a few things I want to point out. So you'll see that there's a couple of sections within that which are broken up by the grey shaded rows. So the first row, grey shaded row block, is on income. So that's, in this case, I'm assuming, and this is for a fictitious training company, and I'm assuming that they've got a north and south. Let's say north of the border, south of the border. And we're going to do a budget for, we've got a budget for the north, and we've got a budget for the south. Then we've got maybe some corporate work that we're billing separately, a different cost center for that. We've got some health work that we're doing, and we've got some general fee-for-service stuff, which is more bits and pieces kind of stuff. So when we set the budget up, let's say this is part of a 6-month budget cycle. 6 months ago, when we set the budget up, these are the budgets that we signed off with. Hopefully, I'm signing off with my manager, but this is the final budget I've been given. My sales budget for my total income for the month of February was 150,000 for the month, and you can see that north was 50, south was 50, corporate was 10, health was 20, fee for service was 20, and they make up a particular percentage. So with workshop north, budget 50,000, that makes up 33.3% of the total income, the 150,000 that's in the shaded grey box below it. So north is making 33, a third of the revenue or the total income that we're expecting for February. South is doing the other third, and the other third is made up from corporate health and fee for service. And I've put in there, just to sort of illustrate what I've been talking about so far, the third column, I've put in whether it's fixed budget, that is, it's locked in, or whether it's flexible, it's going to adjust depending on the circumstances. So with the sales, they're fixed. I'm not expecting that to go up or down. That's what it is, and that's what we'll be held accountable to. If I keep going down on the budget, so down through February, for February, the budget, next is our cost of sales. Remember I talked about this is the money that we've had to spend to make that 150,000. So the key areas around that are on venue costs, where the training occurs, workshop expenses, whatever they may be, might be food or beverage, and training materials that we use. And again, I've broken them up to the total cost of sales. So total cost of sales is 36,000. And so, for example, venue costs 30,000. That makes up 20% of the total sales, of the total income, I should say. And then workshop expenses 3%, and training material 1%. So we're getting a feel for what percentage of the total sales these elements are too. But you'll see with these ones, where the others are fixed, these are flexible. The reason for that is because the business recognizes that if sales go up, the cost of venues, the workshop expenses, and the training materials will go up. And the same if they go down, we expect them to go down as well. So I'll talk about these percentages a bit more shortly, and how that works with the flexible. So we've got 36,000 for total cost of sales in the second of the grey rows in that table. So we take the total cost of sales of 36,000 off the total income, because it's cost us 36,000 to make 150 in sales, 150,000 in sales, and we're left with a gross profit of 114,000. So that's the total income minus the cost of sales, and this is 76% of the total income. So out of every dollar, if I can put it in these terms, out of every dollar that we make over the counter, 76 cents of that dollar is gross profit. So we lose 24 cents out of every dollar to get that dollar, if that makes sense in terms of generating that sale. So that's how we work out the gross profit or the gross revenue, as I think I called it earlier. So then everything after that are expenses. So we've got salary, 25% of sales, that's fixed. Superannuation is fixed because if our salary is fixed, then the super is going to be fixed. Our travel expenses, our mobile phone, our BDC, which is a business development consultant, and we're going to have one in each of those areas. They're contractors, so they're going to be flexible. Wages, which is, say, casual wages, that's flex because we may need casuals up or down depending on what's going on with the sales activities. Admin and service fees are going to be flexed depending on what's going on out there as well. So you'll see the expenses are a combination of fixed and flexed depending on the nature of the expense. And we've got a total expense, which is the second last row, of 105,480, and that's 70% of sales. So that makes our total profit. Our total profit is the expense taken off our gross profit. So total expense is 105,480 is taken away from our gross profit, which is 114,000. We're left with a trading profit of 8,520. So we've made 5 cents out of every dollar as trading profit. That's the percentage of 5.68 on that bottom row. So that's our budget. So let's say we're now in March and we get the report come through for what's happened in February, and that's the actual. So now we're looking at the actual. And if we look at Workshop North income, our budget was 50,000, which was going to be 33% of all sales. Our actual was 48,000. So we dropped 2,000 on our budget. We're down 2,000, and we're only 34% of, or I should say, we're 34% of the sales. So this is where the next column comes in. So in the next column, I've got either F or U. And although some of you might think that stands for something else, it's actually favorable or unfavorable. And different organizations all have different ways to do this. Some organizations will have figures in red, or others and black, depending on whether it's a good or not result. But favorable, unfavorable is pretty much the standard convention. So in this case, sales were down $2,000, but you'll see that the total percentage of sales was up. So even though the figures were down, the percentage of the sales from the north was 34.2%. So that's actually a favorable result. Whereas if you have a look at south was down 11,000, but also the percentage of sales was dropped to 27.8%. So that was an unfavorable result. So you'll have actuals, and then you'll have variations to the budget, and there'll be a determination on whether that's actually a good result or a bad result. So if we work down through it, you can see that depending on different reporting lines there on whether it's a favorable or unfavorable result, and depending on whether it's a fixed budget or whether it's a flex budget, whether that's also considered into the factor of favorable or unfavorable. So if we look, for example, at let's have a look at salary, first line in the expenses. Salary is 37,500, 25% of wages. The actual was 37,500 because it's salary, it's fixed, it was locked in. So even though the percentage is down at 26.7, because it's fixed, there's nothing that could have been done about that. So that would be seen as a favorable result, right? No unexpected blowout there. Whereas if you look at travel expenses, which is a flex, so the third line on the expense component there, travel expenses has a budget of 6,170, has a percentage of 4.1. That's flex. Because the actual was 6,045, even though it's below in numbers, it's actually too high in percentage. So because it's flex, the business would expect you to spend less on travel expenses if your sales are down. So therefore, at 4.31, 0.2% up on budget, that would be seen as an unfavorable result. So just to sort of, so there's an example there just to sort of talk you through a little bit in terms of how you would look at a financial document like that, a financial report such as a profit and loss statement. What would be expected of me as a manager on how to be able to analyze that, to look at it, have a look at dollars and identify variance between budgets and actuals, have a look at percentages, identify variance between budget and actual, have a look at whether it's a fix or whether it's a flex, and then make a determination on whether it's favorable, unfavorable, and investigate where there are unfavorable outcomes to investigate why. And that would mean consulting. We may know the answer, but it might be about just check in with our team and key stakeholders, find out why it's happened. Are there any other consequences as a result of that? Is there anything that's going to come back that might be favorable in the next month? And take all these things into account, investigate, consult, and then report back up in terms of what's going on. So the report will be some type of variance report to let management know of generally what's going on in terms of unfavorable performance. And there are lots of different ones. So organizations will run things like variance analysis or variance analysis reports, which look at just exactly what I did there, current versus actuals, and look for gaps. And then reports that will give the outcomes of investigations and recommend remedial action. So just below the heading there, there's just an example of it, and you would have an extract from a report that would look at something like the variance. So if I look at from that previous slide, Workshop South was under 11,000 for February. After I've done my investigation and consulted, my reasons for it are that COVID restrictions in the southern region caused a shutdown in face-to-face workshops. Workshops were transferred online. However, numbers were lower due to short notice of changeover. The remedial action, what we're doing as a result of that, is that the clients who are unable to attend in February were contacted and have been rebooked in for March sessions. And if we've been able to capture 100% of that, then the southern region sales forecast to exceed the budget by 11,000 in March. So we would forecast that going forward, that we would expect 11,000 to come in the next month over and above the budget. So we're reporting to management that by the end of the budget cycle, we should be back in line. So, we could extend our comments and remedial actions from there. So that's an example of a very basic variance analysis report where we would identify the variance, we would undertake the investigation so that we could articulate what the reasons were, and then we would make recommendations on remedial action. That would go to our supervisor or manager. They would review those. They perhaps might want to contribute to what we can do for remedial action or give us some further guidance or direction, or they might accept that and just expect us to deliver it, and then we'll be held accountable for that again in the next month. But other types of reports that you might see come through, things like revenue and expenditure reports. So you might not necessarily be, profit and loss might not come within your scope of accountability. Maybe it's a revenue and expenditure, so where you get a report every 12 months and you've got every month on what you've spent. Perhaps just an expenditure report, and you've got to check it, validate it, make sure it's correct, identify any favorable, unfavorable outcomes, and report on same type of thing with the variance, the reasons, and remedial actions on any unfavorable stuff. And the same can occur with things like sales reports. And of course, when we're identifying and making recommendations, particularly around remedial actions, there are some good process that we should be following. So we should be able to answer these questions as we're going through the process. What's the things that we're doing? Are they working properly? Are there any problems in what we're doing, whether it's through the sales process or the operational process? were there any quality issues in the systems that we're able to identify to pick up on the problem of why it had a negative financial impact. Are the current controls and systems and checks in place? Like, are we picking up on these things quick enough? Do we need to put more checks or better checks and balances in place so that we can pick them up quicker to nip a lot of these unfavorable outcomes in the bud, so to speak? Are there any problems or issues that need immediate attention that can't really await for the report to go through its due process that maybe we need to jump on straight away? What opportunities for improvement are there? Are there opportunities where we can actually then go beyond the remedial action and actually look at some continuous improvement opportunities? And how will these improvements benefit the organizations? And particularly, we start to quantify it. So when we start to say, this is what we found as the issue, this is what the remedial action is going to be, this is what we expect the financial implications of that will be, and hopefully a positive impact on the bottom line. And then you can talk about how we intend to implement the improvements, and if there are any costs and risks with the improvements that we're recommending, and so forth. And that can be, what are the costs if we do, what are the costs if we don't? And sometimes you'll be asked to, depending on the organization and its processes, and they'll have templates in place if they do have this, but sometimes you're asked to give a detailed financial report. And this is more where you have external stakeholders such as investors or shareholders, where more formalized reporting occurs, where you might need to have some type of clear purpose statement around your report. The purpose of this report is to report on the financial activity of Operation XYZ over the past month. You might include an executive summary, and you might include a distribution list on that. You would then outline what has been your approach for collecting data and your sources of information. So that would basically be describing your accounting system and how it's used briefly. Then any data that relates directly to the area that's being reported. So any trends or shifts going on, so things like suppliers or shifts in the market, any impacts, any contingencies, any of those things that we've been talking about as potential impacts or causes of impact, you would identify. You perhaps might even put that information, that data in some visual context, such as running charts or bar graphs or any of those things, such as the illustration on this slide. You would also include things such as background information if appropriate on sales, what's going on, bills that may still be outstanding, profits that are still in the pipeline, and so forth. You would analyze any problems in that report. You would do a SWOT analysis, identify strengths, weaknesses, opportunities, and threats that are likely to impact going forward. And you would, as I've been talking about, identify opportunities for improvement and making recommendations on those.